We'll now begin with our next panel discussion for the day on the topic Emerging Risks and Trends in the Global and Indian Scenario. To moderate the session, we have Mr. Amit Kumar, Partner and Director at the Boston Consulting Group. Sir, request you to kindly come on stage. Let's have a round of applause for the moderator and the panel members. Joining him is Mr. Sanjay Radhakrishnan, CEO, JLT Independent. We also have with us Mr. P. N. Krishnan, Advisor, Corporate Finance, Punj Lloyd. Joining them on stage, we have K. Sanat Kumar, Chairman and Managing Director, National Insurance Company. And a final panel member for this session, we have Mr. Lakshmi Narayanan Duraiswamy, Chief Operating Officer, Sundaram Asset Management. Mr. Kumar, over to you.
Thank you. Is the mic on? So, ladies and gentlemen, we have a very, very exciting topic for you. I know it's a post-lunch session, and post-lunch sessions are, a little difficult. So, I'll start with, an example which comes from outside an industry that we typically deal with, which is the nuclear power plants. So, let's say that we were designing the key performance indicators for the head of a nuclear power plant, and someone came to us and said, we'll focus on revenues, we'll focus on profits, we'll focus on asset availability. I think it's safe to say that all of us will say, well, metrics around risk management ought to be important for an organization which is running a nuclear power plant. I would argue that, fortunately or unfortunately, most companies today have a small nuclear power plant equivalent business, running within them. And, sort of sometimes we are fully aware of the risks, sometimes we are not, aware of the risks. And, with the panel today, we will, get their perspectives on, how they see the preparedness that, companies and financial institutions have for the risks that, that face us. The second point and the last point that I'll make is that I think there has been a lot of investment in the risk management space. If you go and talk to companies, if you talk to CEOs, you talk to board members, you talk to CXOs, they will say this has been a big priority, for them, and there is a lot of effort that has gone into it. On the oversight front, the regulators, sort of have been very active, sometimes, a little more active than, what the industry would like. There are internal controls, there are internal and external, auditors, but often the risk culture, sort of, seems to be missing, and that, creates different kind of problems. On the organization front, I was talking to someone who was just taken charge at a senior level inside a foreign bank, and foreign bankers will, bankers who work for foreign banks in India will tell you that by and large their global organizations have two customers, the end customer that they serve, and also the regulators and the auditors, because that's just been such a frontline story for them that they've had to really evolve. There has been a plethora of tools, a lot of data is getting collected and is getting used. And I think even on the governance front, with committees being formed and a lot of oversight being created, but at least in my assessment, and we'll go to the panel and get their views on it. We are not ready to give ourselves shining stars on the topic of risk management. It is a topic that is quite relevant, because from the industry's perspective, I don't think enough is being done. It's a challenging environment that we are operating in. So now let's go to our panelists. We have Mr. Sanat Kumar joining us. He's the CMD of National Insurance Company. Let me start with you, sir. As in the role that you play, you have a very unique vantage point on the risk trends that are impacting the Indian economy. Can you share your perspective on what are some of the most significant trends facing Indian companies and customers, and how are insurance companies helping customers and companies in dealing with them?
Thank you, Amit. Let me just deal with the Indian economy in the beginning. One of the trends that really causes concern amongst us is the frequency of the catastrophic disasters that is happening. And catastrophic typically is supposed to be not very frequent, but you see in India, we had this Hudhud claim, we had this Uttarakhand loss, we had the Jammu and Kashmir flood, and then last event was the Chennai flood, which sent about 20,000 crores or something around economic losses to us. This frequency of this catastrophic losses, as we call it cat losses, is a matter of concern, especially the difference between the economic losses. Typical cases, Chennai, which is about 25,000 crores. Insured losses around 5,000 crores. So that difference is now really causing, that is a straight hit to the economy, the difference. Second concern is the lack of penetration. You know that about 0.80% is the penetration of GDP. But on the flip side, we have about 400 million people who have some kind of general insurance cover, which is sizably larger than many of the country's populations, but still it is a concern that a lot of people, especially the vulnerable middle class and the lower middle class and the below poverty line, are either not insured or not adequately insured when some misfortune faces them. Third one, sir, is India is a huge kind of country under agriculture, this thing. So agriculture, as you know, though not a significant portion of the GDP, it still drives a huge amount of employment in this country. So agriculture disasters like failure of monsoon and all that is causing havoc. The kind of havoc it causes in the down to the minutest level of the rural and other areas is tremendous. And agricultural insurance has not been a major sustaining force there. So these are the main concerns with the industry is coming. When you're coming to corporates, general insurance industry is there. We are about, this year we must be touching something around 1 lakh crore of the premium in 15 to 16 this fiscal. But the fact is that one of the things that corporate has to look after, many larger corporators, they're already under high leverage, this is a common phenomenon that you see these days. The adequacy of the cover and adequacy of the value for which they are insured. These are the two things that really, when a claim comes, which is really the moment of truth. When we look at it, they have issues. Either they are not adequately insured, or they forgot to insure something, or they believed the kind of a thing. So I would think that the corporates, major one of them, has to take the risk management as a totality, a very serious affair. Now the Companies Act has now introduced a lot of risk management committee and all that. My fear is that it's suddenly getting reduced to a simple compliance matters. Is it a compliance matter, or is it really a board-driven kind of organization event at that point of time? So that first has to be cleared, and then when it is part of that, the insurance is there. When the risk transfer you are talking about, there the companies has to really see whether all their properties are adequately insured for valuations. There are many methods of valuation. There are valuers available. That's not an easy thing. Second is whether all the covers have been taken. For example, typical case, I would say that many of the IT organization in Chennai, which runs complete support, end-to-end support to their European and US customers, they were down and out for 2-3 days. None could reach the offices. Lack of access and all that. Obviously, their business lost. But most of them had not taken a cover for business interruption due to lack of access to their offices. This is a typical cover offered. Now everybody said, oh, we should have taken that, but that is a point of time. The cover was available, and they would have really avoided a lot of, and even your disaster recovery centers are now under threat. You have a data center, then you have a disaster recovery center. Many of the organizations has disaster recovery center in Chennai, which was supposed to be quite safe. But then we had seen situations where DRs are also been shut down and closed due to situations. So these are all the kind of, so those you need to have a very, today, fortunately, India has enough expertise in risk management advice. There are professional brokers in insurance side who would really give a comprehensive idea. They will look into it. So I think the corporate should move more and more into that. And third, again, that they should really look at the carriers that they choose. There are many carriers in this, about 28. So price obviously is a consideration. There are a lot of price war going on. But a large responsible corporate should see whether the carriers which they choose are able to deliver when the time comes, when they really call for crisis situation come. And further is a little more technical. They get reinsured abroad. So they should see to that which are the properties that they really reinsure with. Are there some kind of unknown entities in somewhere where the risks are transferred? So ultimately, all of them matters when a claim is going to be passed. So we have many situations where, we are reinsured, and when it comes to reinsurance, suddenly we find either reinsurers abroad has disappeared, or they are not able to pay the claim, or they object in some small things, and then the whole, payment network is stopped. So I think these are the things which I immediately think. Economy, yes, obviously we have a lot of risk in that. Corporates also are facing a lot of risk. So this is a very timely event where I think they should have a complete review of what they are dealing with in risk management.
That's a very helpful perspective. Sanjay, let me bring you in to the discussion. As Indian companies get more globalized, as digital becomes more and more core to how companies are operating today. In many ways, we are entering uncharted waters. Can you share your perspective on how's it changing risk management within companies, or how should it change for companies that want to be sort of at the front line of this trend?
Yep. Amit, what's happened in the last decade or so is that a lot of Indian companies have started going outside India for, and there are, today if you see the number of Indian multinationals compared to what it was 10 years back, there'll be a multi-fold increase. There are lots of companies, in fact, if you look at any Indian corporate today, at least 50 to 60% of them have operations either outside India in terms of operating plants or even marketing operations. If you look at a contractor and a civil contractor or a construction contractor who actually does projects in various parts of the world like Africa or it could be Asia, different parts of Asia. So the risks are completely different from what they see in India. So there are, today if you look at the risks, you look at it in two dimensions. You look at property. I mean, you have a company, so you have a plant, so you look at the property and you insure against certain catastrophes, etc. And then you insure the people in the organization, so that's your people. So most companies today look at risk in two dimensions. But the funny thing is that as this world is interconnected, there are two more dimensions to risks. And those two dimensions is, so for example, there is time or space and position. So what I mean by time or space is very simple. So a lot of us have IT platforms, etc., which are in some cloud. I'm not a technical IT person, but all your data is stored in a cloud. And all the information, all your processes, etc., are stored in clouds. And they are absolutely hackable. And this data can go out. A lot of IPR or intellectual property resides in these systems. You could lose that. And there are companies which have been, in the recent past, have actually reached a situation where they could just shut down because they have lost so much of money in terms of liability. Because if you lose, so I'll give you an example. There's a publishing house that we are talking to, and they have 2,000 books which they have, intellectual property that they have with them in their IT platforms. Now, they're not insured against the liability of them losing that data. Now, if it's a big author and if you lose that book and it's already released out in the open, in the black market, look at the amount of revenues that they would have lost, and look at the amount of revenue that the author would have sued the company for. So the risk is phenomenal. Today, we do not understand those risks, and I think that's where cyber insurance, which today is such an important part, and people think that it is only if you have, if you're an IT company, you need a cyber insurance policy. You're wrong. A steel company also needs it. Any company which runs on an IT platform needs a cyber insurance policy. Recently, in a US company, it's a company which sells or distributes power. It's a power company. The power company lost close to $400 million just because somebody hacked into their system and they shut down the power in a particular area. And the power company was sued by a lot of industries in that area because they were supplying power to them, and a lot of processes stopped. Some companies suffered losses, and hence $400 million is what they actually settled down for. There are banks, we don't even see it in the newspapers today because it's a risk which most banks today have. And I know of cases, I know of banks which have paid out ransoms because the hacker actually has 100,000 customers' client details, your credit card numbers, and all they say is that if you don't pay me, say $5 million, I'm going to put this out in the open. And if it's out in the open, then you see the risk that the bank actually undertakes. That's one side of it. The second part was in the dimension is the space. Now, where do you actually operate? So today, companies are operating in places like Africa, places in the Middle East. There's a company which actually has invested close to $1 billion in a plant in Yemen. Now, there is a strife there. Now, what happens to the plant and the investment that has actually been pumped in? What happens to the banks? What happens to the lenders or the consortium of lenders who have lent to that particular company? Now, there are coverages which are called as political risk coverages, which actually cover these kind of risks that most of these companies are exposed to. You also have, you would be sending out employees from India to actually do a project, say, in a place in Congo. Now, kidnap is a business there. Now, your employees could get kidnapped. And how does, you are into construction business, you're not into managing a kidnap or a situation. So you need an insurance policy which covers those kind of situations, which also has a way to actually, negotiate with the kidnappers and get the life back of the person kidnapped. So there are all these solutions that are available, but awareness is something which is relatively low in this segment, and that's something which hopefully will build up as we go along.
It's very useful perspectives. Some scary pictures are coming in my mind, as you were describing the, ransom and the negotiations. Lex, let me, bring you in. Just given your role, you come across a range of companies, some of them doing, great job, which are truly prepared, and some of them, who are really, struggling. What can companies do to assure investors that they are doing enough on this important front?
Thanks, Amit. Let me just take this question in a couple of parts. I'll just briefly, dwell on what Sanjay also talked about. In terms of, the companies that are undermining some of the risk management, events that are going on today, it's not an exaggeration if we say that today technology is redefining the way we, order a cab to, order our groceries today online, and leave alone managing enterprises. Typically, technology is becoming more and more complex to give users the kind of experience that we would all like to experience. But strangely, what it also does is, there are no longer pockets of technology. All of these are today interconnected, and therefore you can't just, address any of these in isolation. The days of, multi-year IT projects or history. I mean, you can't just now plan for something that I will, execute and deliver in the next 3 years. I mean, 3 years, the world changes. I mean, there's nothing that you could just, come up with a project in 3 years, and people are rolling out things in weeks, if not days. But the one thing that I think as risk management professionals that we all undermine is the risks that technology carry today. Typically, until a few years back, when we say talk about data protection, for instance, from a company perspective, all we had was a server to deal with in the company. You just need to log the server, or you need to track the server to know where your data is. Today, there's Wi-Fi, there's mobile, anything can be done. I mean, you can be at home and accessing the company server and then getting the data that you want. And social media. Social media is redefining how we interact with our customers today. No longer, the other day when I was talking to a company where, we was reviewing some of their policies, one of which said, like, we have a turnaround time of responding to emails within 48 hours. I mean, who waits for 48 hours for an email today? I mean, you write a mail, 2 hours, you don't get a response, you post it on your Facebook, you go to Twitter, and the whole world knows about it. So that's the speed with which, customers also work, and that's something that we'll need to understand how we can deal with some of these technology related changes. And typically today, a risk management professional needs to be a technology guy. It's, you need to know the fundamentals of risk management. Yes. I mean, do I need to be a traditional risk guy? Yes. But do I also need to know how technology works, how to leverage technology for risk management? That's absolutely critical. It's no longer can you, work with, old age tools and say that I will solve today's risk issues using, what I learned 20 years back. We also need to refine our techniques and then, deal with the complexities as they change. on the other side, the companies that we look at which have strong frameworks for risk management, how do they deal with it? The first thing that, when we as investors go into companies, do a due diligence and then talk to them about risk management, we see what kind of a governance systems do they have on risk management. Is there a board appointed committee of risk management? And that tells you how serious the company is also about risk management. And what is the senior management talking about risk? Are they walking the talk? Is this just a preach, or is this something that's actually being implemented in the company? And typically, if you look at a risk culture in an organization, it's about a couple of things. It's about what the senior management talks and does, and how they communicate that to the rest of the organization. With so many business imperatives that's going on today, it's the easiest thing to lose focus on today is risk management, because nobody wants to talk about risk management. You are probably an unpopular guy in the company if you say, what can go wrong in a business project. If someone says like, I have a new business idea, hold on, let's just talk about what can go wrong. You're not the popular guy around. But then I think that's very critical from a management perspective to understand, how we pay attention to risk. That's my
very helpful perspective. Krishnan, you work for a large company. Punch Lloyd has many businesses which are exposed to all kind of risks. What are companies like Punch Lloyd doing to prepare for the risks that they face?
Thank you very much, Amit, for raising a very important matter. And before that, I would like to thank. Before I get on to it, I would like to thank ET as well as all of you who are assembled here for giving the opportunity in terms of presenting our thoughts. Coming on to the point that you raised, but before that I also want to dwell upon one issue as to how decision making has become an extremely complex and a challenging matter, given the fast changing landscape in global as well as the Indian scenario, where you suddenly within the last 6 months or even less than that, suddenly few things have cropped up, like the China, the information out over there, the currency devaluation, you have the oil prices nosediving to an all-time low over the last 30 years. So things of this nature, I don't think any risk management or anyone for that purpose was possibly ready for. Everyone was aware of that in China there is something like a bubble that is bursting up, something was happening. The world had still gone and invested large sums of money. There is a considerable investment because it can't be ignored. They are the second largest economy in the world. They are one of the largest importers of goods and services, and obviously you can't, you can't dissociate yourself just because of the risk perspective. That spiraled the oil, the slump in the oil prices, and you are seeing what's happening overall in the global scenario as a result of that, threatening a recessionary trend happening across the globe, more particularly in the European countries. In a situation like this, again, what do companies like us do? Can we just say and follow the economists and everyone to say that, hey, hold on, let's wait and take stock of what's going to be the thing? Or can we do something better? Can we see an opportunity here? First of all, coming on to the role of risk management, I feel while there is a CRO in most companies, and as he rightly said, possibly is the most unpopular person. And I can say this about even the bankers. In fact, there is a CRO in the banks, but when the credit team wants to put up a proposal and go ahead with a decision, they will take his input, but then counter it with their own thoughts around it and get past it. So I think the CRO, instead of being designated as a single person sort of a situation, in Punch Lloyd at least I can say, every one of us or the accountability that is thrust on the senior executives, on the top management. It becomes, everyone becomes a CRO by himself. So at the end of the day, you've got to deliver in terms of the profitability, you've got to deliver on the performance, project execution, and a number of things. And why this is because we have possibly one of the few construction companies, and I think possibly the only one from India, which has presence in about 24 countries in the world. We had our ups and downs. We have learned some very hard lessons in terms of our operations in the international markets and even in the Indian markets. So we know in terms of what we need to be working on, what areas do we need to focus and look at. And but at the same time, there is also a dichotomy in terms of we can't be keeping on. If we really do a complete pessimistic approach about things, then we'll have to possibly not bid for 50% of the projects that we are actually bidding. So we take certain calculated risks, of course, but then those risks are clearly understood, and then we also simultaneously look at what are the mitigation factors. And one thing that we are clearly focusing in terms of, there is a pre-bid stage analysis, then once the project is, the actual bidding goes, at that time a further analysis, and then post-bid, we actually then come again on the drawing table and then look at what are the key factors that we need to look at in terms of budgeting, the financial controls, the procurement controls. So every area that we get into is in terms to look at as to how we can ensure that we do not slip on the total project execution through the lifeline. So these are the various factors that we look at. Earlier days are gone when, I think I will also talk from infrastructure because I have been there in the infrastructure sector for almost about nearly close to 1.5 decades. Earlier was a time that mostly in India, there has been a herd mentality. Suddenly the road sector opens up, a whole number of players who are not there anywhere enter into the road sector. Power opens up, people who have been not know what is PE of the power really get into this because they feel it is like a standard package. You have an EPC contractor, you have the bankers ready to finance, and then you go and talk to your banker friends because you feel that the bankers are the best yardstick to give you, that they are a good barometer to give you an indication as to which are the safe projects and which are the risky projects and where it is good to go and invest. But today you have seen the fate of the banking system. So I think everywhere the story is very clearly that one has to be very vigilant, and especially in the present scenario where all my learned panelists over here have also highlighted, is in terms of what are we giving enough focus in terms of looking at the risk factors and the mitigating factors, both. Because risks will always be there. And certain risks are there which we will not be able to really understand the impact of it, the currency price fluctuations, the commodity price fluctuations. Like today we are seeing a big opportunity. Commodity prices are at almost all-time low. So we see a big opportunity as the number of projects that we are likely to gun for in the next few years, as to how we can take this as an advantageous factor for us in terms of looking at how we can mitigate some of the risks that can come up in the future on the biddings that we will be doing. Coming on to insurance, I think before this we had a brief interaction and I was able to get some useful insights from both Mr. Radhakrishnan and Mr. Sanath in terms of looking at what are the various products that are available and how it can, some of them are not available on the Indian shores, some of them are available definitely on the foreign shores, where how we can leverage that as well in terms of looking at mitigating some of the risks. So these are the few things that I would like to present before you. So it's a complete organizational approach that we have, at least at Punch Lloyd, in terms of, and there are periodical reviews there are, the board reviews some of the major projects. And also in terms of looking at the financial control, there we have put a very strict tightening that every deviation, even in the sub part of item, if there is a deviation happening, then there has to be backed with a complete justification, otherwise funds are not released. So one more important area that we really look out for, typically most construction projects, there is a certain amount of working capital that gets locked into the construction contracts. We try to see as much as possible as to how we are operating without locking in our working capital. So we take certain clear stance. We stall the projects when we see that the client is not paying up or not agreeing to the differences or the claims that we submit. We had burnt our fingers in the past of completing the project and then holding the baby as to our claims not getting paid. Now we have changed the approach on that. And I think that is, though almost all construction companies are going through a difficult phase, but at least Punj Lloyd, to my knowledge, is at a point where, we are moving on to a new direction where we hope we will not commit the past mistakes.
So with that, I come to my favorite part of the panel discussion, which is audience questions. The panel can take any questions that any one of you might have. Can we get a mic? Can you please share your name and the company that you work for before you ask a question?
Good afternoon. My name is Delzad and I am from ICICI Lombard. When we talk about emerging risk areas, an area of risk which has caught the attention of all corporates is reputation risk, for the simple reason that that can have a colossal impact on your image with the public. Even from a banking perspective, it could mean that a higher amount of NPAs mean that the depositors have lost confidence and begin withdrawing their deposits. And recently we've seen some of the biggest brands in the world suffer on account of that. So if you had to maybe enlist, I would say about 5 steps which every corporate can take to handle reputation risk successfully and make sure that even once a negative media publicity has come, they handle it in a way that they minimize the extent of damage they suffer, what would those 5 steps be? Thank you.
I think one point is this company should trawl the social media. I mean, many of them do that. I mean, there are many kind of agencies which trawl the social medias against any kind of positive or negative feelings that has been dispersed about that particular bank. And the moment that thing starts in a social media, whether it could be anything, there are now methods, there are now advisors, there are now consultants who would address that particular corporate, how to handle at that point of time, and start a counter kind of social media engagement. Today I was told, I mean, we have, a lot of people are approaching us to create WhatsApp groups, which would, keep on, because this has now become a very powerful tool. Create WhatsApp group which will continuously churn out positive image or the other side of the story to the public. For example, you say that the State Bank of India has large, NPAs. Then this story will go around saying that why it is so, why the steel is down, why the power sector is down, while the coal is down, while the gas is not taking off. So the persons who are seeing that gets the other point of it. This is, I see, as a major, emerging instrument that is being handled. And there are now, I'm very interested to see that a lot of consultants which is coming into this would give a very comprehensive solution to how to track the social media and be above that. I mean, there's one step which I would certainly look at.
I would like to add on that. Okay, sorry.
Please.
No, go ahead, Sanjay. After that, we can get.
If I were to add on to that, I think a couple of points. One is, see, you don't react to a crisis when the crisis actually happens. You have to plan for a crisis, or rather, you don't, typically it is not the easiest thing to do is to plan for a crisis. But what large corporates do today is the PR planning does not actually happen at the time of a crisis, when the crisis hits them. it is planned well in advance. So most companies already have a crisis management or a crisis management situation, and they plan that very well in advance. So if something happens, let's say there is a product recall of 50,000 cars of a particular company. Now what do? So they already have those 4 or 5 steps that the PR agency comes in, there is a holding statement, there is a campaign which is run after that, and then probably a rebranding of the brand, etc., etc. And those things are already done in a large number of large corporates. But having said that, your question is very pertinent, because as we go along, the kind of chemicals that we use, the kind of products that we make today, we don't even know what the impact of that is today. So for example, there is a medicine that we take, any medicine. The long-term impacts of those medicine are not yet studied. So 10 years down the line, there could be class action suits against that company because of certain kind of chemicals that they have used for a plastic product or for a medicine or for any product for that matter. So these are some things which companies need to prepare now and cover themselves, and all these risks are transferable. You can transfer these risks to insurance companies. Product recalls are there, and it's a cover that is available in the market today in India, and complex covers are available even outside India. So that would be my take on this.
Krishnan?
Yeah. I think one more very important factor, especially for what you have talked about, especially in a situation like companies turning into NPAs and the reputational risk that it comes to, and possibly you are talking from the recent experience of a particular business person being very much in the news, whatever. I think corporate governance is one area where one should really focus and set standards of being impeccable in terms of the corporate governance standards. And I think that is an area where one should focus a lot, because ultimately at the end of the day, the business cycles would be there. One has to keep facing the challenges. It is how effectively you are communicating with the stakeholders and being transparent about the state of affairs of the business. Like for example, I'll just give an example in terms of Punj Lloyd itself. Most of the construction companies had gone for what is called as a debt restructuring, the CDR package, which is also a very good approach of rather turning into an NPA, at least go upfront to the banks, find a solution, and if it is a temporary short-term challenge, how one can look at overcoming that with a solution that the bankers can provide. We did the same thing, but we did not do a CDR approach. We worked out a detailed giving out of information to the banks as to where our money is stuck. Like for example, we have money stuck with ONGC, we have money stuck with some of the other clients on the claims that are entertained by mediating agencies, but then not really finally paid out to us. So situations like this, the banks were able to really appreciate and understand as to where the money is locked and how the company is working towards addressing those challenges. And then looking at also in terms of the corporate governance standards that we have also set in terms of passing on the information. All these factors built together at least has helped Punj Lloyd to not get under a category of a restructured asset or an NPA sort of a situation, but definitely been able to work on a proactive basis. So I think that is where I would like to stress a little more on.
Thank you. Any more audience questions? So in that case, let me ask a question to Sanjay. Sanjay, you mentioned about cyber risks. I remember reading the story about Sony Pictures, which many of you may have seen the attack that happened on their company, and the company was under a lot of stress and had lots of losses. Can you share a little more, besides, being aware of it and ensuring that, you are upfront thinking about the insurance, that you need? What else, can, companies do on this important front? Because this is going to become more and more important, in our context.
Yeah. Actually, what typically happens outside India is that there are IT consultants or cyber consultants. Now, cyber consultants actually come in and check. So today, when we look at cyber security, we have certain firewalls. Some people have 4 firewalls. Some people have different kinds of firewalls. But is it really protecting your data? Is something that some of these cyber security experts come in, actually gauge, and also give you a potential loss. So, for example, they will tell you that these are the gaps in your cyber, security policy. These are the 4 gaps that they feel that they can actually enter, and that's called as ethical hacking. So they have hackers who will get into your own system and show you. So, for example, we had a seminar pretty recently, and the guy who was giving the seminar actually hacked into one of the people sitting there in the audience. He asked him his email address, and he actually hacked into his email address live on screen. In 15 minutes, while he was having the conversation, in 15 minutes he hacked into the other person's email address and showed him that this is how easy it is to actually get into anybody's systems. And it was quite an eye-opener. And some of these cyber security specialists, they're expensive, but it saves a lot of cost when the event actually really happens in your organization. So that's something which is...
Please.
Actually now in financial services sector like banking and insurance and all that, across the world, the regulators are also seized upon this as a major critical area. So in India and in many other countries which we are working with, the regulator says that your core operations data should never be on the cloud. I mean, whether it's right or not, I don't understand, but then they say your core operations data should never be on the cloud. You can put your ancillary, a lot of activities like payroll, your customer relations, and your other kind of MIS and all that on the cloud, but it's better to have your core insurance, core operations, the core banking or core insurance in the land, within the country in which you operate, which is being regulated, and also within your own data centers which are within your control. So this is probably one of the regulatory interventions that is happening these days.
This is very, very helpful. This is a risk, I think, which a lot of companies don't fully understand. So I think the input from both the panelists is very very helpful. Krishnan, let me bring you in on another emerging trend which we've discussed for some time, but should deserve a few more minutes, which is about the political risks in countries that you operate in. We've all heard about the airport that one of the large Indian companies is trying to operate in
Maldives,
and what happened there. As Punj Lloyd operates in these countries, is there an active discussion about? Is there an active discussion about, as the political environment changes, which we are seeing with more and more, countries, about the emerging risks and, what needs to be done?
Yeah, definitely. In fact, we have, I would say one of our large money that is stuck is in a country like Libya, where definitely when we actually entered that country, it was a darling of the Western world. So it was, in terms of credit rating, very high. It had the 5th largest reserve in terms of the petroleum reserve, the gas and the crude reserve that they have, and a very high GDP. There was no reason that, and it was one of the westernized in terms of their living style, lifestyle, everything. So there was no reason for us to even look at a political risk insurance in that country. Though we did take in one of our projects where we were operating a couple of our rigs by one of the subsidiaries of Punj Lloyd in Libya, and we did get paid for the policy because it was insisted by actually the lenders So many times we do it as a matter of a compliance to avail of a loan or a financial facility. Having said that, we are now, after this experience, we have been looking at it fairly closely, or ways to de-risk ourselves otherwise. Just another parallel example, we got a project in Yemen. This was the one thing which I was missing out the other day in the conversation. So Yemen, of course, as you all know, is an extremely troubled country, civil unrest. So what we did was, we did not put any of our financial commitments on stake over there, except that we won the contract and subcontracted the whole of it to a local Yemenis company, contractor. And we are only looking at a markup profit on that, which we will collect when the project gets completed or as the project keeps moving. In a way that we have de-risked ourselves. So is there a way that we can de-risk ourselves and be there in terms of our top line and the bottom line growth objectives still being achieved? Otherwise, we clearly avoid countries where we see a possible political, because whatever political insurance cover that we can take, if there are really troubled countries, even the political risk insurance don't come in or come at a very high premium. So then it's not, whatever profit, anyway most construction companies operate at a profit margin of 10 to 12%. So a high political risk insurance, then in fact it eats into your profitability. So it's not even, we don't look at it from that angle. But having said that, yes, we have been actively discussing with the insurance companies in places where we feel we need to do that. Like countries like Petronas, where we are doing a project, we feel it is not necessary, it's a fairly stable Fortune 100 company, so we don't feel, we have past working experience with them. So countries like this, or certain areas, for example, the political risk is very particularly significant, especially when it comes to Middle East countries. We operate in a fairly large way in some of the Middle East countries like Qatar, Abu Dhabi, and other areas, Oman. The local laws over there, very clearly, we try to see that the governing law is the English law. At least that way we are then not subjected to the local laws prevailing over any disputes or anything that can come up. And as much as possible, we try to put our revenues in dollar terms so that we are avoiding the local currency movements that can happen. So these are some of the things that we look at. But having said that, in a period at this particular point of time when there are paucity of projects or there are challenges on that sort of a front, we then take certain calculated risks also.
Very helpful. Any last question from the audience?
Yeah, question. I have one quick question, please. So I'm Vimal from Liberty Videocon General Insurance. My question is, Companies Act 2013, when passed, it mandated that there has to be deposit insurance. So companies who are going out to public for deposit, accepting deposit, they were supposed to have an insurance. So that is rolled back now. The recent Companies Amendment Act has, rolled back that, and the reason which was given there was that there is no support available from the general insurance industry. So it was recommended that since it is a hardship to the companies who are accepting deposit, so it is rolled back. So my question is, clearly it is an emerging risk from the deposit holders' point of view. If you look at the companies in late 90s, and so lot of money was lost in so many schemes. Now, my question maybe to Mr. Kumar. What were the few reasons why insurance company did not gear up for the products which could have been used there for covering those schemes?
See, deposit insurance was traditionally provided by Deposit Insurance Corporation of India. That was exclusively to the banks, basically. So up to 1 lakh, now I think the amount is 2 lakh. The deposit insurance does provide. It's not mandatory, but most of the banks' deposit insurance are covered by this entity. So traditionally, this was outside the general insurance industry itself for a long time. So that was basically not a insurance accident cover. It was basically belonging to, I mean, suppose this company winds up or the company is not able to repay its deposits, and that is why it's not there. That exactly did not fit in with the current kind of perspective of journalist industry today. So that way we don't give performance guarantee bond, we don't give this kind of deposit insurance traditionally, because this is seen as outside the purview of the journalist industry, and it needs a different expertise itself. It's basically a credit rating exercise that goes into it. It's an analysis of the fundamental financial status of the company, which is not that what we are equipped for or what we have expertise in. So that's why we are not, in the industry is not offering a deposit insurance to that extent. But we do come into the help where, where there is an accident or there is a damage to the whole thing. Then if something happens to the customers, then we do step in to protect that. But not purely a financial derivative instrument. We are not there. I mean, I know Sanjay can add to it.
You're right. I think it's more of a business risk. As a depositor, you are actually taking a risk on a company for a particular return on that. So it's almost like it's not a risk per se which can be transferred. It's a business risk. So it's like, you can't insure yourself against currency falling. You can take a forward cover for that. That's a financial instrument that is available. So similarly, it's not a risk transfer that can take place in a risk which is a business risk rather than a actual risk per se.
Let me just add one point to that. I believe one of the other reasons why this was rolled back was also a commercial reason. When you take it outside of the Deposit Insurance Corporation and give it to the insurance companies, the question was who was going to pick up their tab for insurance. You tell the deposit companies saying pick up the tab for insurance, they're going to say that, like, look, it's going to come from the customers who are going to pay the deposits. I'm going to pay them an interest and I'm going to pay you a cost for insuring that. That's not going to really work from the economics for the deposit raising firms, and pretty much that was going to kill the deposit taking companies. So that was, I believe, the other reasons why most of these deposit companies also represented.
So with that, I'd like to thank all our panelists for taking the time out, to join us for the discussion. We've had a fascinating discussion. This continues to be a very important, topic. And thank you to all of you for being such, wonderful audiences. Thank you.
Thank you.
Thank you.
Thank you so much, gentlemen. I request Soumya Gopinathan from ETH to kindly come forward and present a memento as a token of appreciation from our side. I would also request our panelists to kindly come forward for a group picture, please.